In the gleaming heart of Singapore's financial district, where mirrored skyscrapers reflect the restless pulse of capital, a quiet name began to surface: Smart Digital Group. On paper, it was an unassuming company, 14 employees, core services in digital marketing, event planning, and software customization, a regional player operating across Singapore, China, and Macau. Yet, within 2 short years of its founding, this small firm made an audacious leap onto Nasdaq, the world's most demanding stage for public companies. And that is where the mystery begins. Smart Digital Group was incorporated on November 3, 2022, through a Cayman Islands holding entity with its headquarters in Singapore. From inception, it was built as a multi-jurisdictional structure, Singapore at the center, with subsidiaries in China and Macau forming its operational arms. Such arrangements are common for multinational tech conglomerates optimizing for taxation, foreign investment, or regulatory arbitrage. But for a newly formed small-scale marketing firm, it was strikingly atypical. Startups of that scale generally establish local entities first, then expand once operations stabilize. Smart Digital Group, however, began life as if it were already preparing for global listing. This, analysts note, is the first anomaly, a company architected for capital markets long before proving business fundamentals. Then came May 1st, 2025. Smart Digital Group priced its initial public offering at $4 per share. The next day, trading commenced on Nasdaq. Under normal circumstances, a company would require at least 3 years of audited financial history, profitability metrics, and the backing of a major underwriter to reach this stage. Smart Digital Group had none of those. It was only about 2 years old, and its offering was handled by a relatively minor underwriting firm rather than a global investment bank. Yet the process proceeded swiftly and quietly. This was the second anomaly, a remarkably smooth listing for such a young, little-known company. Why the rush? Was it strategic timing, opportunistic momentum, or external influence pressing for a listing window before scrutiny tightened? No clear explanation ever surfaced. Post-listing, its financials revealed another contradiction. Revenue reached approximately $28 million, a 120% increase year over year. Impressive on the surface, but net profit fell to around $1.9 million, a decline from the previous year. Ordinarily, when revenue doubles, profits should rise proportionally, unless significant reinvestment or one-time costs are involved, yet no such expenses were disclosed. No cost breakdown, no note on operational expansion, no R&D explanation. The lack of transparency was the third anomaly. Investors were left wondering, was revenue growth being inflated by aggressive booking? Were margins eroding due to internal transfers across its offshore subsidiaries? The silence left room for speculation. The fourth anomaly arrived on September 23, 2025. The company abruptly announced it would create a cryptocurrency asset pool, investing in digital assets like Bitcoin and Ethereum to diversify its portfolio. The pivot was baffling, a digital marketing company suddenly venturing into crypto asset management without expertise, licensing, or prior signals. Normally, new ventures extend logically from a firm's competencies, marketing into ad tech or software customization into analytics. But Smart Digital Group crossed into an unrelated, high-volatility financial arena. This raised serious questions about capital allocation discipline. Some observers theorized this move was an attempt to offset cash flow pressures or to capitalize on speculative crypto rallies. The absence of a detailed strategy or risk framework made this decision appear impulsive rather than strategic. Then came the fifth anomaly, a regulatory thunderbolt. On September 29, 2025, before market open, regulators abruptly halted trading of Smart Digital Group's shares. The suspension lasted until October 10th, a full 10 days. Such actions are typically reserved for cases of accounting irregularities, undisclosed material information, or manipulation suspicions. Yet no formal reason was made public. The company's statement was brief. It was not involved in price manipulation and was cooperating with regulatory requests. That was all. Normally, listed firms issue a follow-up filing clarifying the cause and expected timeline for resumption. Smart Digital Group did not. The silence following such an extraordinary intervention only deepened the mystery. Days later, the depository trust company, DTC, put a global lock on the stock, suspending settlement and clearing. Effectively, even willing buyers and sellers could no longer complete trades. Korean brokers soon blocked orders as well. Under standard market practice, a DTC global lock occurs only when severe compliance concerns or legal uncertainties exist, rarely within months of a company's IPO. This marked the sixth anomaly. When settlement stops, it is more than a technical glitch. It signals that the market no longer trusts the asset's legitimacy. Examining the corporate structure reveals why this situation unnerved investors. Smart Digital Group's architecture, Cayman Islands Holding Company, Singapore HQ, subsidiaries in China and Macau, forms a network optimized for flexibility, but not transparency. Funds can flow across jurisdictions with minimal disclosure. Add to that the proposed crypto asset pool, and tracing capital becomes exponentially harder. Investors could not clearly identify where earnings originated, how funds were allocated, or which entity held what risk. This is why the case of Smart Digital Group matters. It is not simply a halted stock story. It is a study in how trust erodes when structure and transparency diverge. In a typical IPO's first year, management builds credibility through steady financial reports, consistent communication, and operational clarity. Smart Digital Group instead delivered a perfect storm: a trading halt, a global lock, and a radical business shift, all within 4 months of going public. Each event might be survivable in isolation, but together they painted a portrait of systemic opacity. The deeper mystery is not conspiracy, it's disconnection. The company's advertising-based business model, its crypto venture, and the regulatory freeze all exist in parallel but without logical continuity. That lack of coherence is what unnerves investors. Markets can handle bad news. What they cannot price is uncertainty. Smart Digital Group became a symbol of precisely that uncertainty. Ultimately, the only path to redemption lies in transparency. Verified numbers, detailed disclosures, a clear articulation of how the crypto strategy fits or doesn't fit into its core business. Without these, trust remains broken, and even resumed trading would not guarantee stability. Before we close, a word to our audience. The ValueStir channel invites your participation. If you follow or research stocks, listed, unlisted, or preparing for IPOs, or emerging cryptocurrency projects, share your insights in the comments below. Your observations often become the seed for our next investigation. And to all of you who watch, subscribe, like, comment, and share our videos, thank you sincerely. Your engagement drives us to create more rigorous, detailed, and thought-provoking analyses that serve serious investors like you. This was ValueStir.